Hey everyone, welcome to another edition of the Buddy Study Group, and we're here today with friend of the show, Larry Moore, and NGL is the name of the game today. So we're going to be going over Honest LTC, product that was released by NGL very, very recently, within the last couple of weeks. I think there's a lot of really exciting things to look for in Honest LTC compared to Essential LTC. If you're one of the states that has moved to the Honest LTC generation. Lots of really interesting client-centric benefits, but I'm not going to get too ahead of myself. Larry, I will let you take it from here. We really appreciate the time, but today we're going to go through a product overview, talk about some administrative stuff, and of course, your questions. So drop any Q&A you have in the chat, and we are happy to answer those either as we go or at the end. Happy St. Patrick's Day.
All right. Happy St. Patrick's Day to everybody. Um, yeah, thanks for having me, guys. Appreciate the invitation to come on, and was glad we could do it this quickly. Um, with this audience, typically you guys are brighter than most, so maybe you already know a fair amount about what's going on with our new product. But what I'll do is I'll walk through some of the high points, share with you some pricing comparisons, so you get a sense of where we lie in the marketplace. And Jason, I assume you'll just be fielding the questions that come. So
I'll be
don't
your
hesitate.
eyes.
Yeah, just interrupt me if it's a crucial question. We go from there. All right.
Cool.
So first of all, yes, we've been waiting for a long, long time for this, and we launched about 4 weeks ago now. As I look into it, these are the compact states that we are in, and I'll forward this PowerPoint to Jason so he can feel free to distribute among all of you. There are four compact states that aren't in this list, primarily because there were additional filing requirements that they required. So we're waiting on Massachusetts, Rhode Island, South Carolina, and Illinois. They're going to be awfully close, though. It's just a matter of some ancillary forms. But one of the things that we've done from a policy standpoint, because we do like the new product so much and agents like it, finally, we have something that we've ironed out the wrinkles where agents had concerns about, especially around, daily benefit versus monthly and calendar day versus service day. We have kind of a hybrid elimination period along those lines. But there is an exchange program in place. So if you sold Honest LTC, or I'm sorry, if you sold Essential LTC in any of those compact states, right, where the new product is available, you have up until April 14th, not 15th, April 14th, to exchange the old product for the new product without any proof of insurability. Okay. If there's an interest and you like the way the pricing might look, and we can help you with that, um, by all means, you can exchange the old product for the new. It would require a new PDF application to be completed and signed. And again, you have until the 14th of April to do that. So it's kind of a neat upside opportunity for you as well. Um, Moving forward, when we look at a high level, what have we retained? We've retained really the strong features that we already have, like the joint product for couples. And as you're probably aware, our definition of a couple is very loose. It could be a traditionally married couple, domestic partners, people living together. It could be siblings. It could be parent, child. Um, as long as two people are living under the same roof and are sharing expenses, that counts as a couple. So every now and then we get the question of, well, there are these two people, they're deeply committed to each other, but he lives in New York City, she lives in San Francisco, and they get together every so often. Does that count? And the answer is no. That does not count as a couple in terms of how we do it.
Larry, quick question. Are you
Yes.
advancing your slides? Because we're still seeing the title slide.
Oh, wait. How's that?
There you go.
Okay. I'm sorry.
Thank you.
Thank you for telling me, Gretchen. I was looking at the wrong screen. I got three going on here.
Well,
So,
thank you to Jeffrey. So thanks.
you should. um,
Oh, Larry, by the way, one more question from Diane in the chat. How far back of an issue date can you go to offer that exchange that you were talking about?
May 1st, 2025. So
Perfect.
anything after May 1st, 2025. Okay.
Thank you.
All right. Thank you. Sorry for the technical hiccup here. So anyway, joint product. obviously still around, and we talked about couples. The shared benefit amount rider, which we call the third pool, is also still available. We talk about a spousal survival benefit. What do we really mean by that? Well, I don't know really why we say that, to be honest with you, but um, basically, you have a couple, and if one of the partners dies, never accesses any of the benefit, or may have accessed some of it, whatever remains, all or some, goes to the survivor. And the survivor has the option to keep that rider, or if they want to save about 28% on the premium, drop it. Right? It's up to that person. But that's what we talk about with the survival, spousal survival aspect of it. It remains a real popular option for us because it allows you to sell a shorter duration contract and then throw in the third policy, which basically replicates the value of each individual's contract or policy and provides a lot more leverage. So when we stack up against Mutual of Omaha, especially in Thrivent, that's where we play really well. And what I like about how we've approached shared benefits is that we don't force one policyholder to cannibalize the benefits of the others, right? Each individual's policy within a joint policy structure is protected from each other. The integrity of the benefits is always protected unto themselves. It's the third pool that they would share. So that's that for that. We still have the 10 pay option. Although I'll tell you, it's kind of an interesting scenario with the 10 pay on the new product. As you know, the old 10 pay on Essential LTC is guaranteed, right? There's a 10-year guarantee on that product. It's a nice feature. The compact state, largely due to heavy influence and lobbying from a carrier that I will not mention, basically told us that no traditional product should have a 10-year rate guarantee. You can't have more than five, right? So we have 5 years of the 10-year or 5-year rate guarantee on the new product. We didn't like it. We didn't want it. The regulators told us we had to do it. And as for benefit periods, you'll see 2, 3, 4, 5, and 6 years. You'll notice that unlimited is missing. It's because we eliminated unlimited. And I'll kind of give you a high level reason why we did. First of all, we were never selling it. I think we sold one or two a year. But what we wanted to do with this product was keep pricing as close as possible to Essential LTC. So it wasn't like this huge bump in premium. And that was one way, actuarially, we were able to create enough confidence with our actuaries that, yeah, okay, if we eliminate the unlimited risk portion, that might be a way to protect ourselves and still bring premium down a bit. So unlimited is gone, all right? The elimination periods are still 90 days and 180 days, and I'll talk more about the elimination periods in the next slide. And of course, we still have the first day home and community care rider, which actually is very attractively priced on the Honest LTC product. With Essential LTC, it's about a 25% load in premium. New product's only 10%. So we're already getting a lot more interest in that combination of where I go with the 0-day wait on home care and then, with the 90-day on the facility, that's fine. And know that every day that you satisfy on that home care stay counts against the 90-day elimination period on the facility side. So that's a nice scenario. Any questions at this point, or we're good to still move forward?
There's a question in the chat, Larry, about what are the age limits?
Oh, good question. So we've expanded that a bit. It's now as young as 30 and as old, 35 and as old as 79. So we've gone down to a younger age.
And I believe that's attained age now. Is that correct?
Correct. Yeah. And actually, we don't have age nearest anymore. It's actual age. We did find some people, not a whole bunch, but some that made the transition over and actually saw their premium go down because their actual age was less than the age nearest. So that could happen from time to time.
And there's another question here, Larry, about the first day home and community care rider. What all is actually covered under community care? Because we got folks asking about facility under that rider, or what would apply there?
So home and community care, it's home care, it's adult daycare. It could be something along those lines, adult foster care in some states. So that's pretty much what it is. When we talk about the facility side, that's where we see assisted living and, hard, brick and mortar type facilities.
Sure. And would essentially would their elimination period continue to um be satisfied if they're taking home health benefits that first day?
Yes. Yes.
Okay,
So you think about it this way. If I received home and community care for 90 days and then transition to a facility, there's no elimination period I have to satisfy.
perfect.
Okay. All right. Going to the next page. Got a really tricky mouse here. Um, we've evolved from a daily benefit plan to monthly benefits, from 1,500 to 12,000. So, our old product is capped at the equivalent of 9,000 or $300 a day. Um, we're doing this in $300 increments, so you get some anomalies in terms of monthly benefit amounts. Like instead of, you may be going from 57 or 4,700 to 5,100. It's really not that big of an issue because our pricing is putting us still in a good spot. So toe to toe with Mutual of Omaha, in many cases, not all, but in many cases, 5,100 will be less than 5,000 with them. Uh, the count. This is the big debate. We created a big debate about calendar day versus service day, and it's like politics and religion. We just can't win this one. Let's just say that it's a big improvement than what we had with service with our current service day, which is 1 day of service, for 1 day off the elimination period. Our elimination period is patterned off what we used to see from the old days of GE before it became Genworth. It's 1 day equals 7. And I guess you technically could call it a service day because it's a service day requirement. So if I receive 1 day of services in my home or in a facility, that counts as 7 days off the elimination period. So it's still pretty fair. To call it a true blue calendar day approach probably is not 100% accurate, but we'll call it the hybrid if that makes sense. Okay? It's a big improvement over where we were. Um, we've also added several inflation options. Instead, we used to have 3%, 5%. Now we go 1% all the way up to 5%. I've actually quoted older ages like 67, 68, with the 2%. It's kind of interesting because you have more flexibility to play with that.
Is that adjustable, Larry, at any point?
Only down,
Gotcha.
yeah, not like Mutual of Omaha where they'll allow you to go up or down without any proof of insurability. Always easy to downgrade, but if you're going to increase it from 2 to 3, then there's an underwriting situation.
Right. So you could start aggressive and get more modest over time
And
if you need it.
right, and intuitively, I think about if people that go on a fixed income, I don't think their intention is to increase their cost of insurance. It's probably to decrease it. So probably more likely they would go down, but that's just an assumption.
Sure.
Yeah. As far as more client-friendly benefits, we now offer a 5% partner discount if in a situation there's a couple applying and one is declined, or if only one of the two is applying. So there's a 5% discount for that. So at least we're recognizing that now. And we talked about age-based premiums based on your actual age rather than age nearest. And then we've added alternate plan of care in writing. In spirit, we embrace this at the time of claim, but now we're saying it. So the nice thing about this product is that you can basically say that it will evolve with the time as long-term care delivery changes over time. And it's going to be that classic, if it's mutually agreeable between you, your physician, and us, that will help you best establish, the ability to meet your ADLs or need for supervision, then alternate plan of care holds. So questions on that?
So reimbursement though with an alternate plan of care, right?
It's all reimbursed. This is not an indemnity product, correct?
So in just trying to understand the elimination period, Larry, we had a question. Would 14 days in a row of services received satisfy a 90-day elimination period with the 1 = 7?
Yes.
Perfect.
Okay. Actually, you know what? Let me recant on that. Um, I don't. I better verify that before I go out on a
Okay,
limb on that one. So I'll get
sure.
back to you on that because um, that question came up a while ago, and I know we didn't have an answer for it. So let me verify that
Okay,
because it would make sense. Because if you receive 1 day of care in that access, that takes 7 off. Um, but I'll get back to you on that one. That's a good
okay.
question. Okay. Going into some numbers just to give you a sense of where we fit. This is a joint case, 3 years, 90-day elimination period, 4,500 a month, 3% compound. Our shared benefit amount rider compared to shared care with Mutual of Omaha and Thrivent. Where you see yellow, that basically means we win, right? In this case, if you just even run with age 60 is kind of a midpoint, you'll see we're at 57.85 to Mutual of Omaha's 65.67 and Thriving 61.63. But what's even more important is look at the size of the leverage. We're giving you 486,000 to their 324,000. So without belaboring the point, and I have a couple of other scenarios to share with you about couples, we look really solid. Now, I'll be frank, if you have a wide disparity in age between male and female, so if I have a younger female and a much older male, we lose some of our juice right there. I had a situation where we had a 57-year-old female and a 71-year-old male, and Mutual of Omaha was beating us. So when you think about how we've built the pricing around this, we're less competitive with males. So if there is a big disparity that way, younger female, older male, you're going to find that we lose some ground there. Okay? Now, taking this joint 3 year product to the next step, we thought we'd throw in the 0 day elimination period for home care so you can get a feel for how that works. And again, because we're talking couples, depending on the age of the couple, we again play pretty well. Now, keep in mind that these comparisons are based on identically aged people, right? Male, female. So again, the same scenario resides. If you're looking like a 2 to 5 year age gap, not a big deal. But when you start getting 5, 6, 7, 10 years age gap between the younger female and the older male, you'll want to keep your eyes open with our competitors as well, because you'll find the rates may even come close to us and beat us in some cases. Right? So we've been looking at the 3 year scenario where you can definitely see we play pretty well. I thought, let's just throw in a 5 year for the fun of it. And this is just a straightforward joint 5 year, 90-day elimination period, $4,500 a month, 3% compound. And same scenario, right? Again, just with couples, that's our strong suit. Identical pools of money, but if you look at 50 to 60 years old, we're 59.69 to 76.06. So yeah, pretty solidly competitive in the couple space. Okay. Looking at just females alone, we play okay there too. This is single female, 3 years, $6,000 a month, and we look pretty solid there. So females, males, females or couples, we seem to hold up pretty well. Throwing in the 0 day home care EP, same story. We seem to play well with that. I think we priced that 0 day elimination period for home care pretty competitively, and I know a lot of agents are starting to look at it already. And then again, to just throw in the 5 year, still pretty solid, right? We're still in a good spot when you look at us, Moo, and Thrivent. Thrivent's closest to us across the board. Mutual of Omaha is quite a bit higher as it relates to this. Now, getting into males, you'll see that's where we give up a little bit. This is just 3 year, 90-day EP, 6,000 a month, 3% compound. And you can see the numbers are very tight in this space. For age 60, we're 26.94. And then there's Moo right there, 32.86. And then Thrivent, just a little over 3,000. So it's real tight there. And then We give some up to Thrivent in the older ages. And I think you'll find that too with Mutual of Omaha as well. We seem to give up a little bit on the older side of the equation. Um, Finally, looking at the 0-day wait for home care, same story. It's just tight. I think it's safe to say across the board, males, single males, that's where we lose a little bit of ground. There's one, and I'll throw in the 5-year duration as well. So 5-year, kind of a little more all over the board. Thrivent takes a little more away from us. Um, when you look at all the durations that we have, 3 years, 4 years, 5 years, 6 years, you'll see anywhere from as little as 3% to 9% bump, where ages are fairly close. Where you're going to find the bulk of the premium bump, it's going to be the 2-year iteration. So with 2 years, you're going to find 24% higher premium, largely because we felt we underpriced it in the old product. So they trued that one up. So when you go into 2 years, say, wait, Larry, what are you talking about? There's a big bump here. You're right. That's where it's going to be. But yeah, aside from that, those are the numbers. I don't have much else to show as it relates to product other than I'd be happy to take more questions. And of course, I'm going to follow up with an answer on that elimination period. So,
Yeah, Larry, just a question for me. Has anything changed from an underwriting stance? Have you done a refresh there? Are there any conditions that you feel underwriters have more leniency on? Do you feel like there are conditions that underwriters are more strict on? Anything from like the code of what underwriting runs by that you've seen changed lately, or where you feel you're competitive today?
sure. I think we're pretty competitive as it relates to family history and Alzheimer's and dementia. So, for instance, with us, you could have two first-degree family members who either currently have dementia or Alzheimer's or died of it. If they were diagnosed with the condition after age 75, we'll allow that applicant to apply, like Mutual of Omaha would not. But there is something you want to be aware of. When we do underwrite, this is a change, and it's largely due to a knee-jerk reaction to a situation we had unfold. Um, Historically, we'll do a face-to-face cognitive assessment on any applicant over 66 years old, right? And it was just that one person. So if there was a younger spouse, well, they dodged a bullet. Now, moving forward, if there's an individual who would trigger the need for a cognitive assessment, 66 or older, and their spouse or partner is age 60 to 65, that person will also have a face-to-face assessment. Okay. We have a situation going on, what triggered that? We have a situation going on where there was a couple, they applied, it was a single premium, unlimited benefit plan, maxed out $300 a day. And the husband is 82 or 62, excuse me, and the wife was 66, triggered a cognitive on her. Within 8 months, they filed a Alzheimer's claim on him, the young guy. So this kind of is a result of that, just so you get a sense of why we did that.
Sure.
So that's what's going on there. I would say that we've come a long way as it relates to lymphoma or cancers. We used to have a 10-year waiting period. We're down to 2 years now on that. So that's kind of important. As it relates to depression, major depressive disorder is truly a debilitating condition. And people who wrote with us early on, like 4 years, 5 years ago, we would rubber stamp the clients on cases where we saw that code, MDD, just didn't want, because we know that by definition, the severity of that condition is really severe. You literally cannot function. What we began to learn, though, and a couple very astute agents brought it to our attention with the cases that they were presenting to us, that code is often overused, used for billing purposes or used for securing certain types of medication, whatever. If somebody has MDD in their medical records, it doesn't necessarily mean that they're truly majorly depressed. We had a situation where the agent came back after the case was declined. and appealed it. Said, listen, this guy runs a company. He runs marathons. I mean, he's just like a physical specimen. This guy is may have some depression, but he's not majorly depressed. And when we looked at the case, we felt the agent was right. So it went from a decline to preferred plus. It was a California case. So in that area where we see major depressive disorder in the medical records, we pull that application offline and try to fill in the gaps. You know, is this person highly functioning? If so, then that's a good case for us. Um, Another area that when I think about um, physical therapy, we've come a long way there too. We used to have about a 6 month wait for physical therapy in general. If it was for a mild recovery or injury, and you're better after 30 days and physical therapy is done, 30-day window is all you need. Major accident, major disability, it could be 6 months, and maybe even up to a year, depending on if it's really an acute problem. But we've eased up there as well. I'll tell you, I think the toughest area we reside is in the area of diabetics. No insulin dependent diabetics. I know some carriers will rate them. We won't take them. If it's an A1C that's, under 7.5, that's good. But if there's comorbids associated with that, such as heart disease, bypass surgery, stent implantation, we know the reality with diabetes. It's a deteriorating condition over time. So we watch that one more closely than others. So I would say when you think of NGL and they're diabetic, make sure you learn a few things about them. What their A1C is, their stability, that there's no comorbids associated with that, excessive weight, that kind of a thing. We're getting our underwriting times down pretty low, largely due to our Client Connect and eNOA. We're imposing some technologies that are turning things around a lot quicker. So we're seeing typical turnaround times now in the low or the high teens to low 20-day, 22, 23-day mark, especially if they're younger and there's not a lot to secure. We've seen some cases go through in just over 2 weeks. So I think we're doing a pretty good job there. And if you look at our declination rates, if you're in the younger ages, say under 55, we're declining maybe 22, 23% of the business. When you get up into the early to mid 60s, you're getting closer to 30%. And when you're getting up to say 68, 69, 70, you're getting into the high 40% range, right? So our declination rates, I think, are pretty consistent with the marketplace, with our competitors. So that's it. I would tell you right now, aside from the product, the area you want to get comfortable with, and I'm happy to set up tutorials with you directly when you think you have an NGL case coming up. Let me run a tutorial with you on our Client Connect e-application system. For anybody who's wrestled with that system, I'll call, say, 6 to 8 months ago, much better user experience now. We got pretty much most of the bugs that are really important worked out of it, and agents seem to really like it once they've used it 2 or 3 times. But my counsel to you, if you want to have as good of experience as possible, give me a call. Say, I think I have an NGL case this week. Would you mind running me through the Client Connect app? And I'd be happy to. You'll be relieved that it does work pretty well, but it's so different from anything else out there that when agents see it for the first time, it's not what they expect to see. So that's kind of how that goes. We still have PDF fillable applications available for people who like paper, but nonetheless, that's what I would suggest. And we also have a very efficient e-policy delivery system as well. It works very well. But again, agents who are accustomed to receiving a physical packet in the mail, going through it, and then mailing it forward to their client, you can deliver a policy and amendments and any documents with us in a matter of seconds and have the whole thing wrapped up easily within the day, if not within the hour or minutes. It works very well. It's different. So I would say with the technology, get comfortable with us. It's different, but it works very well. What else can you
Awesome.
do? Yeah.
Yeah, I got a question here about some of the pricing comparisons, and we had somebody asking about Joe asked about a 65-year-old male
Mm-hmm.
comparing with Thrivent and mentioned that you guys were winning out on a continuous pay, but not on a 10 pay. So I guess thoughts on that.
Our 10 pay is not that competitive. I'll just leave it at his observation's spot on. We don't give away much on a 10 pay.
Well, there you have it, Joe. I hope that helps.
Good question.
Yeah, it does help, Romeo.
Perfect.
Anybody else? Let's see. Um, so Gail, I think, joined in the middle. If you want to just flip back to the pricing slides, Gail is um, looking at shared benefit and how
Okay.
it compares to other joint plans.
Okay. So this is that 3-year example with our shared benefit amount rider to Moo and Thrivent's shared care. And we'll just run 60 since that's a good midpoint. This is a $4,500 a month plan, 3% compound, 90-day elimination period. And we're at 5785 for $486,000 in combined benefits, right? Versus 6500. So almost 900-ish more a year for 324,000. And then Thrivent's pretty close to us as well. So get rid of that ball there. So that's kind of where that plays pretty well. And then Dale, what we also did was take this and take it a step further and throw in the 0-day EP for home care and see if we still hold up. And we still do, for the most part. We're at 63 for 486,000 to 75.52 for 324. And Thrivent still has 324 too. They're a little closer to us. But and then if you want to see just a straight 5-year, there's no shared care there, so there's no point in showing you that one. So
Yeah.
hopefully that gives you a feel for it.
And third pool is something that many of us really, really like for
Yeah.
good reason.
I just wanted to add in, I had a case where I did the share plan and the couple got divorced. And it's very
Mm,
interesting how
yeah,
that played out because
yeah.
the client that was my key client, the wife or the almost ex-wife, said, how can I control, how can I divvy this up, or how am I going to be able to control that my ex-husband eats up the third pool, can we prevent him from doing that? And I said, not really, no. So we just sold her a smaller Mutual of Omaha plan only, but she kept the NGL plan. But
Mhm.
it's interesting when we start seeing these shared plans, and the third pool gets a little funky, in terms of how you would work that out. Not that I don't know how many people on the call have had that, but
What
seems
comes
to
up?
be,
It,
1 out of 2.
yeah, no, I get about, 3 or 4 inquiries a year about that. What if they get divorced? And so, well, the judge may say you just have to play nice when it comes to your long-term care policy. But yeah, otherwise, the only other way to protect the integrity of benefits is you drop that third pool, and then
Yeah,
no
she
matter.
didn't really want to do that. I just say
No.
it's a good thing you didn't stay married to him because you would have had a lot of caregiving involved anyway, or coordination. Just kidding. Okay, I'll get off.
She saved herself a headache, maybe, right? What else?
Let's see. Romeo requested an updated agent guide, underwriting guide. Those are in the chat now. I dropped those in. Um, Gene was asking about joint waiver premium
Mhm.
and how that works, how waiver works for joint cases.
That is a great question. So when you have a joint policy, it's interesting. Think of it as I have 2 separate insurance policies with identical benefits welded together under the form of this group or this joint product. So each individual does have their own elimination period, but that only would relate to their own claim. So think about our joint policy, one policy and one elimination period at a time. So spouse one goes on claim. When the elimination period is satisfied, the entire premium then waives. And then if spouse number one passes away or exhausts their benefits, then what the survivor would experience is a drop in their premium, except for California. California still has the old product there. Expect a drop in the premium, and then when that person goes on claim, that person will also have to satisfy their own elimination period at that time before their premium waives. So I hope that makes sense.
Dean, let us know if that makes sense for you.
I had to unmute, and I've got to think about that. And it's good seeing you on the call, Larry.
Hey, Gene, go on now. So, Gene, did that make sense, or do you want me to rephrase it?
Yeah, rephrase that, would you please? I'd appreciate that.
No problem. So when you think about our joint policy, again, I have two individuals that have identical benefits, call it 3 years, $200 a day. Each of them has that to themselves. And the integrity of their benefits is protected under that guise too. One can't invade the other one, right? Each individual has their own elimination period as well. However, what that means is if one spouse goes on claim, only that elimination period needs to be satisfied. And at that point, the entire joint premium is waived and remains waived as long as that claim goes on. And then as time marches forward and that individual, maybe they pass away, what will happen is that premium will resume, but it will be a reduced premium because there's one less person on that case. And that survivor does have their own elimination period that they will have to satisfy someday if they go on claim to make their premium waive. Does that make sense?
It does. So it's two separate issues. One is the elimination period, and one is the premium waiver we're talking about. But I understand it. Yeah.
Perfect.
Thank you.
You bet.
Anybody else have any questions for Larry while we've got him? I know we have much more to come and to cover with NGL. There's a lot more to what NGL is doing that we don't have time to cover in a 1 hour session. So I'm sure you'll be seeing Larry and even more of the team in the future, maybe do a demo on the Client Connect in general, just for everybody to kind of take it in and ask any questions. I know there are some goings on for the worksite side. So as that continues to develop and we're kind of, from NGL side, ready to promote more of that, you may see them pop up on a Thursday call to talk about the product and how it works from that perspective. So there's a lot more than just this presentation to cover with NGL, but Larry, we did have somebody request your contact info or a scheduling link so they can book a demo. Would you be able to provide that?
Yeah, I don't have a schedule link. I wish I did. Those are kind of nice to
You
have.
got to get one, man. We have a study group twice a year where I basically just yell at people to get a scheduling link. So
Well, we have this thing called compliance, and that gets in the way. Yeah.
yeah, makes sense.
So my email address is ljmoore, Moore, at nglic.com. Again, LJ Moore at nglic.com. And my contact number is area code 206-321-7737. Again, 206-321-7737.
Good deal. And then, yeah, Larry, if there are any other, helpful pieces that the audience can use, of course, the slides, if you're comfortable with sharing them, I'll make sure that those go out with a copy of the recording after the study group is over.
No problem.
Um,
I'll take a look.
Anything else that you want to leave the audience with, or make sure that we know, or one single simple takeaway that you want everybody to know before we start wrapping?
Well, let's see. What can I say? I remember when NGL called me 5 years ago, and my gut reaction was NG who? I had no idea who these people were, right? And it took a little convincing since all of us who've been in this industry, and I just look at some of the people on here, I know you all have been in this business a long, long time, like I have, you get a little jaded and you want to make sure the carrier you're with is going to be around a while. Um, what sold me on NGL was the reality that this carrier was very fortunate to be late to the dance. So 10 years ago, when they entered the marketplace, they really studied. We really studied the learning curve that the industry had encountered and entered the market right from the beginning. Proper lapse assumptions, proper interest rate assumptions, proper morbidity assumptions, proper underwriting, all up front. All the things that many of our contemporaries just simply didn't know when they entered the marketplace. So our prospect for stability is really high. When I mean stability, I'm talking about premium stability. I can't say the word guarantee because it's not what the product is, but we're going to be very stable. And to give you some perspective around that, we have a whopping 5 claims on the books. So we have a lot of wiggle room here. And understand that I think a fair question is, well, if NGL, they even know how to pay claims. The answer is we don't, but Life Care does. So Life Care is our third party administrator. They're paying hundreds of millions of dollars in claims for decades. So we kind of have the best of both worlds. We got a company with very little exposure, no legacy business, beautiful financials with a TPA that knows exactly what they're doing and does a very good job of it. And I will tell you that Life Care is incredible to work with. The access I have to their people to solve problems for you all, it's unlike anything out there. So those are probably some high level takeaways that should make you feel pretty good about working with us.
Yeah, I think we know a couple people over at Life Care, and
I
can
think
can
so. There's a
agree that
couple
they
of
do
them. Yeah.
and can agree they do a pretty good job.
Yeah.
And yeah, I mean, you know, NGL is not new to long-term care now. I can't sit here and say new necessarily, but this is really the first major new product generation that you all have released since entering the market.
Yeah.
And you know, I was I was in the industry long enough to recognize NGL as a brand new long-term care product. And now to see it get to this point, it's like the experience that is under your belt as NGL, and what you have, really borrowed and partnered with from Life Care is starting to grow in its own way. And it's exciting to see this new identity. And like I said, a lot more to come. So
Yeah.
I think that was a great way to wrap it. Unless anybody else has any other questions for Larry, we can get you out of here. Well, this thing's supposed to end at 1:45. It never does. So I can't say early, but
Yeah.
earlier.
There you go.
Alrighty, I think that will do it. Larry, we really appreciate you taking the time out to get us started on Honest LTC. And like I said, we'll look to more sessions as we're kind of getting the product experience under our belt with this, and
Mhm.
we're ready to promote a few other cool things. So
Sounds
thank you
great.
again. Everybody be
All right.
well, and we will talk to you this time next week. Have a good one.
Have a good one, everybody. Thank you.